Yes, your boy Crypto Blood, and welcome to another episode of My 2 Cents. This morning we're looking at crazy. This is even out of CNBC. They're saying this. You know, normally I like to pull from non-mainstream media outlets. Of course, I do have an article from Zero Hedge as well, but this one is actually out of CNBC. Credit Suisse shockingly calling that the Fed will launch QE4 by the end of this year. Now, the end of this year is only, we got like 15, 16 more days to the end of the year. So this just lets you know, guys, what the hell is going on. It is dire, cold blue for the markets if you have Credit Suisse saying this. Insane. So we're going to take a look at this out of CNBC and also write this name down. Zoltan Pozsar. We'll take a look at why you should know that name and why you should care about his opinion regarding the repo markets here in a second. But before we start, if you guys find these types of videos informative, make sure you like, share, and subscribe, and click that bell to receive more videos like this. Let's take a quick peek at what the markets did yesterday. Dow Jones down just slightly, down 27 points. They're keeping it up, man. I'm telling you, they're trying to keep this thing together. You know, a lot of these hedge funds and pensions have nowhere else to go. To be honest with you, they have nowhere else to go. The stock market is the last frontier. It's the last frontier, and it's going to end badly. It really is. But until then, they're going to keep it propped up. But even before that, you guys may know him. Jeff Gundlach, legend in the game. Double Line Capital. I don't know if you guys follow him. I've followed him for many years, and this type of guy that really has a what I want to call level-headed approach to the markets. No fluff, no emotions. He's pretty level-headed when it comes to his analysis. Even though he's known primarily as a bond guy, he definitely has some great ideas and insights as far as, you know, the equity markets as well, because they do play off of each other, right? They're not mutually exclusive. But he said, I watched this video actually on YouTube. I'll try to link it if I remember. It was out of Yahoo Finance, but essentially Jeffrey Gundlach, who has over $150 billion under management, sees trouble brewing in the debt market despite interest rates hovering near historic lows. In a recent discussion with Yahoo Finance, Gundlach compared the current expansion to the boom that took place nearly 100 years ago. But the next decade will be the opposite of the roaring 20s, as he said, as the debt bomb the U.S. is sitting on becomes untenable in the next economic downturn. He said it's pretty interesting because in the 20s there were super boom times, and weirdly I think the 20s this time will be very much different than that, with real turmoil. The 60-year-old billionaire said in recent wide-ranging interviews with Yahoo Finance. In Gundlach's view, the 2020s will see the crescendo of many unattractive trends that have been talked about for years but finally coming home to roost. He says we're going to have to face Social Security, healthcare, all of these things, deficit-based spending. All of that is going to have to be resolved during the 2020s because the compounding curve is just so bad. And again, I've told you guys, had an interesting interview with Ted Seidel, and he's a whistleblower, the biggest corporate whistleblower actually in history. Over 78 million won in the last 10 years from whistleblowing against corrupt institutions like JP Morgan, you know, and the pensions, many pensions around the country. You know, Gundlach talks about Social Security, healthcare, and other deficit-based spending, but that also includes, and he didn't say this, but pensions. Pensions are another huge issue. It's almost like a domino effect. Once one falls, they're all going to tumble because they're all counting on one another to keep things looking like everything is okay. And according to the Congressional Budget Office, the federal deficit will top $1 trillion every year beginning in 2022. Yet Gundlach said the agency's forecast may be too rosy, given that it assumes a pretty benign future with no recession and interest rates that are not very high. Interest costs to the government has a percentage of gross domestic product and are expected to rise from 1.25% to at least 3% by 2027. That's a big increase, and that's coming, the investor told Yahoo Finance. So as you can tell, and you know, Gundlach, if you guys don't know, Gundlach was really one of the first major figureheads. I wouldn't say the first, but one of the first that, you know, came out and on CNBC, this was last year, and said, hey, look, we've got a problem. We have to stop playing this fairy tale narrative. CNBC was covering that interview pretty tightly, which I was actually pretty surprised that they even did that. You've got Ray Dalio actively talking about, you know, the coming recession and issues with, again, many of the topics that Gundlach touched on in this interview. Social Security, pensions, healthcare. These are smart individuals and have amassed enough wealth to where they can just keep it real at this point. Anything that happens, they'll be fine. Even if they lose 40, 50, 60% of their wealth, believe me, they're not hurting. So them, coming out talking about this is something we should definitely, pay attention to. Let's take a look at what Zero Hedge has to say, or at least I should say Zoltan Pozsar said about this repo debt market and what he's saying is going to happen in the next coming days. He says it's about to get very bad. Repo market legend predicts market crash in days. And I got to give a quick shout out to Slake Thirsty for the Zero Hedge article that we're reading right now. And it really lines up with what CNBC and the Credit Suisse article that I bookmarked. And, it's all coming together. It says the name Zoltan Pozsar has been among the most admired and respected on Wall Street. Not only did the Hungarian lay the groundwork for our current understanding of the deposit-free shadow banking system, which has been often opaque and painfully complex short-term dollar funding in repo markets at its core. And this is kind of an infographic, if you want to say, to illustrate what I call and what Daniel DiMartino Booth wrote in her book, Fed Up. And I'll leave a link to this. You guys really need to read this book, Fed Up. It really breaks it down like to the T. But what she calls money conjuring mechanisms. That's essentially what this is. This right here is just a money conjuring mechanism. A complex way to just say we're creating money. Basically. But anyway, it says he was also instrumental in his tenure at both the U.S. Treasury and New York Fed in laying the foundations of the modern repo market, orchestrating the response to the global financial crisis and the ensuing policy debate, as virtually no one at the Fed knew more about repo at the time than Pozsar, serving as point person on market developments for the Fed, Treasury, and White House officials throughout the crisis. What he does do in his latest note, titled ominously Countdown to QE4, is explain why the Fed's interventions to date have failed to reverse the underlying plumbing issues in the banking system, manifesting themselves in a dramatic increase in treasuries at the time U.S. Bank and JP Morgan offset a decline in reserves, i.e. cash. So take a look at this. These are the JP Morgan loans and securities. And what you want to focus on is the green one at the top. It's showing you a decrease in loans. Okay. That's not good. You need loans we need more debt to create more credit. It's this debt-based system that we're in. So you see at the peak there, steadily heading lower. So that is a problem. That is not a good look. Pozsar goes on to explain what we need from the year-end turn to go well. Our balance sheet neutral repo operations, or asset purchases aimed at what dealers bought all year, which are coupons, not bills. The former to get around foreign banks, balance sheet constraints around the world, and the latter to ensure that excess reserve accumulates with large banks like JP Morgan. Unfortunately, the Fed is doing neither. So to translate here, Treasury yields will spike, Pozsar warns, identifying the trigger of forced sales of Treasury bonds at the end of the year. He basically goes on to say, this is a very long article, and I'll let you guys read the whole thing. But he basically says that there are two scenarios that we could see. Encourage foreign central banks to use the FX swap lines, or number two, which is probably what's going to happen, start QE4 by switching from buying bills to buying coupons. Of the two options, Pozsar believes number two, the Fed launching QE4, would be the proper decision. And that's in the next few days. QE4 would help through the back door by reversing the mistake of balance sheet taper. QE4 would mean buying back from dealers and banks the treasuries that were forced to buy during balance sheet taper and giving back the reserves they gave up in the process. In Pozsar's conclusion, he says QE4, as much as it makes sense, won't happen unless the Fed's hands are forced. But I'm pretty sure the Fed's hands will be forced. I mean, this is a bunch of spaghetti. In coding, we call this spaghetti code. Convoluted mess, throwing any and everything at the wall to see what sticks. And when you're in that type of situation, it can't end well. But this is the main article out of CNBC, and it says the fourth round of quantitative easing will be needed before year's end to address stresses in short-term lending markets, according to Credit Suisse analysts who we just talked about, Zoltan Pozsar. So-called QE4 would help rebuild bank reserves, which have dropped as the Fed has shrunk its balance sheet. The article says that all those efforts stem from the mid-September tumult in the repo market, the place where banks go to get overnight funding critical to their operations. So it says that 17th of September spike in rates amplified funding issues that Pozsar said are not going away. And we know they're not going away because they're doing over 85 billion a week. The problem, he says, identified are in twofold: a Fed that raised rates too much and cut its bond holdings and balance sheet too quickly, coming at the same time as Basel III international banking guidelines made capital requirements more stringent. So before the balance sheet drawdown, Fed had been running what is considered an ample reserves regime, where reserves a year ago had been around 1.8 trillion. That number dropped to close to 1.4 trillion in September, and the Fed has wrestled since with what is the right number. Pozsar specifically described the potential for QE4 process as helping through the back door, with the Fed buying back the bonds that banks were forced to buy during the balance sheet rundown. However, of course, most fixed income experts think the central bank's market operations have kept the market running smoothly. Indeed, the funds rate for the past month has been around 1.55%, which is near the bottom end of the target range. The Fed usually is satisfied if the rate trades around the midpoint, which would be around 1.62. So, of course, Pozsar is a contrarian in this case, because if people thought like he did, we would already be there, right? These markets are forward pricing, and so the market is where it is because the consensus in the market is where we should be, right? Most people think that we should be where we are. The people that make the most money are those who are the outliers, or on both up and down, who position themselves accordingly. So Pozsar is definitely kind of out there by himself in relative terms. Because again, we would see that price in the markets if he weren't. So I'll leave a link to both of these articles. The CNBC one is a little bit easier to digest, and it touches on the same ideas and concepts that were talked about in the zero hedge one, but in a more condensed fashion. So man, it's game time, people. It's make or break. We're at the end of the year. We got maybe about 16, 17 days left in the year or so, and it'll be interesting to see how the Fed ends the year, because they're going to have to show their hand at this point. No more kind of just acting like everything is okay. They just have to come into the repo markets just to bring yields down from 10%, just because that's normal. A spike to 10%, higher than the 2008 financial crisis. This is normal activity, guys. Nothing to worry about. Well, we're going to find out by the end of the year if we should be worried or not. But hey, that's my 2 cents on the topic. Make sure you leave yours in the comments below. If you found this video informative, also make sure you hit that like and share button and click that bell if you do subscribe to receive more daily videos like this. I'm out of here, people. How?